There's a simple number that determines when the Federal Reserve officially acknowledges that the United States economy is entering a recession. It's not the gross domestic product, it's not the stock market, it's not even consumer spending, it's the unemployment rate. Specifically, it's how much the 3-month average of the unemployment rate rises above its lowest point from the previous 12 months. When that gap reaches 0.5 percentage points, economists and policymakers believe the economy has already entered recession. This threshold is called the Sahm Rule, named after economist Claudia Sahm, who developed it as a straightforward recession indicator. As of December 2025, the Sahm Rule stands at 0.43 percentage points. In other words, we are just 0.07 percentage points away from triggering one of the most reliable recession signals in modern economic history. The next jobs report, expected in February 2026, covering employment data from January, will likely determine whether we cross that threshold. For someone in retirement or approaching it, understanding what that threshold means and what happens when it's triggered is essential for portfolio planning. Let's start with the mechanics. The unemployment rate in January 2025 was 4.0%. The lowest 3-month average during the past 12 months was 3.87%, achieved in early 2024. The current 3-month average unemployment rate is 4.30%. The difference is 0.43 percentage points. If the unemployment rate in January 2026 comes in at 4.4% or higher, the 3-month average will likely push the Sahm Rule to 0.50 or above, triggering the recession signal. This is not speculation. The data is nearly deterministic. Unless the January unemployment report shows a surprising drop in the unemployment rate, a reversal of the trend from the past 6 months, the Sahm Rule will trigger. Moody's Analytics, the Federal Reserve, and other institutions have all acknowledged that we're on the precipice. One more month of unemployment at 4.5% or above, and the signal fires. Here's why this matters for your retirement. The Sahm Rule has been extraordinarily accurate historically. Since 1950, every time the Sahm Rule has triggered, the United States economy has either already been in recession or has entered one within the following months. The rule has never had a false positive. It has never signaled recession without one actually occurring. That's a 100% accuracy rate over 70 years. However, there's an important nuance. The rule is accurate at identifying recessions, but it doesn't determine their severity. The Sahm Rule doesn't tell you whether a recession will last 3 months or 3 years. It doesn't tell you whether stock markets will decline 20% or 50%. It simply says a recession has begun or one is about to begin. The current labor market data showing the path to Sahm Rule triggering is worth examining in detail. The unemployment rate has risen from 4.0% in January 2025 to 4.4% in December 2025. That's a 0.4 percentage point increase in a single year. Meanwhile, job growth has essentially stalled. The average job gain in 2025 was only 49,000 per month compared to 168,000 per month in 2024. That's a 71% decline in job growth rate year over year. More concerning is the 3-month average. From October through December 2025, the average job gain was negative, meaning the economy actually lost jobs on net during that quarter. Manufacturing has been particularly weak, losing jobs every month for the past 8 months. Construction employment has also fallen. Retail employment has declined. The only sectors adding meaningful jobs are healthcare and leisure hospitality, which are generally lower wage sectors. This data pattern, rising unemployment, slowing job growth, 3 months of negative job creation, is exactly what you'd expect to see in the early stages of a recession. The Sahm Rule is designed to identify this precise pattern, and we're about to hit the threshold. What happens when the Sahm Rule triggers? Historically, a few things occur in sequence. First, acknowledgement. Financial markets take notice. Credit spreads widen slightly as investors become more cautious about corporate debt. Stock market volatility increases. Second, the Federal Reserve typically responds by cutting interest rates, if they haven't already begun doing so. The Fed views a Sahm Rule trigger as a signal to ease monetary policy. Third, the recession continues to unfold. It doesn't reverse immediately upon the signal. The unemployment rate typically continues to rise for several months after triggering, reaching a peak in the middle or later stages of recession. For retirement portfolios, this has specific implications. If we're entering a recession, historical precedent suggests stock market declines are likely. Recessions are not good times for equity valuations. The average stock market decline during recession is 30 to 40%. Some recessions have larger declines. The 2008 recession saw a 57% decline. The 2020 COVID recession saw a 34% decline. Most recently, the 2001 recession saw a 47% decline from peak to trough. A 30 to 40% portfolio decline is manageable for someone with decades to invest, but it's problematic for someone in retirement drawing income. If you're drawing 4% from a portfolio and the portfolio simultaneously declines 35%, you're forced into a difficult choice. Either reduce your income dramatically or continue withdrawing at elevated rates from a depleted portfolio. The latter path leads to portfolio depletion in 8 to 10 years instead of 25 to 30 years. This is where the Sahm Rule's approaching trigger becomes urgent. If you're near retirement or already retired, the next 45 days until the January jobs report comes out in early February represent a critical planning window. The Sahm Rule is likely to trigger. When it does, financial markets will reprice. Asset allocations that made sense in a bull market may not make sense in a recession. Some observers argue that the Sahm Rule might be less reliable now than it has been historically. They point to the fact that the labor force participation rate has been increasing even as unemployment has risen, suggesting that the unemployment rate rise might be due to people entering the labor force rather than job losses. That's a fair observation. In recessions, labor force participation typically declines because discouraged workers stop looking for jobs. If participation is rising while unemployment is also rising, it suggests the dynamics are different. However, that argument only goes so far. Job growth has clearly slowed dramatically. Unemployment has unambiguously risen. The 3-month moving average has unambiguously increased. Even if the precise reason for that increase is somewhat different from historical patterns, the practical impact is similar. Fewer jobs are being created relative to the number of people looking for work. And in a recession, employers don't remain hiring at historical rates indefinitely. At some point, the labor force participation stabilizes and job losses accelerate. The current data suggests we're approaching that point. What's also relevant is that the Sahm Rule trigger doesn't require a recession to already have begun. The rule indicates when recession is likely imminent, so the triggering of the rule is not necessarily a statement about economic reality right now, but rather a high probability prediction of what's coming in the next few months. For retirement planning purposes, this distinction matters less than you might think. What matters is, will financial markets decline in the next 6 to 12 months? If Sahm Rule triggering is an extremely reliable indicator of imminent recession, and imminent recession typically leads to 30 to 40% stock market declines, then the approaching trigger should influence your portfolio positioning now before the decline occurs. Consider the alternative. If you wait until after the Sahm Rule triggers to rebalance your portfolio, you'll likely be doing so after stock prices have already begun declining. The psychological difficulty of selling stocks that are down 10 to 20% is much greater than selling at current prices to reduce concentration and prepare for the decline. You may freeze, unable to make the rational moves needed to protect your portfolio, simply because you're watching your holdings decline in real time. The data on investor behavior during market declines is clear. Most retail investors sell at the worst times, after significant declines have already occurred. The institutions and sophisticated investors who protect their portfolios during downturns are those who act before the decline, based on signals like the approaching Sahm Rule trigger. What should someone in retirement do right now? Several concrete steps deserve consideration. First, audit your portfolio's defensive positioning. How much are you allocated to bonds, cash, and dividend-paying stocks? If you're 100% in equities and approaching or in retirement, you have too much risk. A 30 to 40% portfolio decline is manageable for someone young, but it's devastating if you're simultaneously drawing 4% income from a smaller pool of assets. Second, ensure you have sufficient cash on hand, typically 18 to 24 months of living expenses in cash and short-term bonds. If a market decline occurs in the next 6 to 12 months, you want to be able to cover your living expenses from cash rather than being forced to sell stocks at depressed prices. Third, establish a plan for what you'll do when the Sahm Rule triggers. Don't wait to react emotionally. Decide now. If recession is signaled, will you rebalance? Will you reduce equity exposure? Will you increase bond allocation? Having a written plan in advance is far more likely to lead to rational decision-making than reacting after the signal fires and markets have already begun declining. Fourth, understand the tax implications of rebalancing. If your portfolio is in tax-deferred accounts, IRAs, 401ks, rebalancing has no tax consequence. If you have taxable accounts, selling winners to buy protection may trigger capital gains. Work with your accountant to understand the after-tax implications of your rebalancing strategy. The Sahm Rule trigger is coming. It's not certain that it will happen in the next 45 days, but it's highly probable. When it does happen, financial markets will react. That reaction will likely be negative for equity valuations. The time to prepare is now, before the trigger fires. For someone in retirement, the Sahm Rule approaching its trigger threshold is not a time to panic, but it is a time to act. The warning light is on. The data is clearly pointing toward recession. The question for your portfolio is, are you positioned to survive and recover from a 30 to 40% market decline? If the answer is no, the next 45 days are your window to take action.